Hello everybody and welcome to Stock Market Advice. Today we are looking at Howard Marks' thoughts on asymmetry. What is it? And how can it help you become a better stock investor? Howard Marks describes asymmetry in his most recent memo in the following way. Asymmetry is a concept I've been conscious of for decades and consider more important with every passing year. It's my word for the essence of investment excellence and a standard against which investors should be measured. First, some definitions. I'm going to talk below about whether an investor has alpha. Alpha is technically defined as return in excess of the benchmark return, but I prefer to think of it as superior investing skill. It's the ability to find and exploit inefficiencies when they're present. Inefficiencies, mispricings or mistakes, represent instances when an asset's price diverges from its fair value. These divergences can show up as bargains or the opposite, overpricings. Bargains will dependably perform better than other investments over time after adjustment for their riskiness. Overpricings will do the opposite. Beta is an investor's or a portfolio's relative volatility, also described as relative sensitivity or systematic risk. People who believe in the efficient market hypothesis think of a portfolio's return as the product of the market's return multiplied by the portfolio's beta. This is all it takes to explain results, since there are no mispricings to take advantage of in an efficient market, and so no such thing as alpha. Thus, alpha is skill that enables an investor to produce performance better than that which is explained purely by market return and beta. Another way to say this is that having alpha allows an investor to enjoy profit potential that is disproportionate to loss potential, asymmetry. In my view, asymmetry is present when an investor can repeatedly do some or all of the following. Make more money in good markets than he gives back in bad markets. Have more winners than losers. Make more money on his winners than he loses on his losers. Do well when his aggressive or defensive bias proves timely but not badly when it doesn't. Do well when his sector or strategy is in favor but not badly when it isn't. And construct portfolios so that most of the surprises are on the upside. For example, most of us have an inherent bias toward either aggressiveness or defensiveness. For this reason, it doesn't mean much if an aggressive investor outperforms in a good year or a defensive investor outperforms in a bad year. To determine whether they have alpha and produce asymmetry, we have to consider whether the aggressive investor is able to avoid the full loss, which his aggressiveness alone would produce in a bad market, and whether the defensive investor can avoid missing out on too much of the gain when the market does well. In my opinion, excellence lies in asymmetry between the results in good and bad times. As I see it, if inefficiencies are present in an investor's market, and she has alpha, the impact will show up in asymmetrical returns. If her returns show no asymmetry, the investor doesn't have alpha, or perhaps there are no inefficiencies for her to identify. Flipping that over, if an investor doesn't have alpha, her returns won't be asymmetrical. It's as simple as that. To simplify, here's how I think about asymmetry. This discussion is based on material I included in my 2018 book Mastering the Market Cycle, Getting the Odds on Your Side. While I may appear to be talking about one good year and one bad one, these observations can only be considered valid if these patterns hold over a meaningful number of years. Let's consider a manager's performance. Market performance plus 10% minus 10%, manager A. Plus 10% minus 10%. The above manager clearly adds no value. You might as well invest in an index fund, probably at a much lower fee. These two managers also add no value. Market performance plus 10% minus 10% manager B. Plus 5% minus 5% manager C. Plus 20% minus 20%. Manager B is just a no-alpha manager with a beta of 0.5, and manager C is a no-alpha manager with a beta of 2.0. You could get the same results as manager B by putting half your capital in an index fund and keeping the rest under your mattress. And in the case of manager C, by doubling your investment with borrowed capital and putting it all in an index fund. These two managers, however, do have alpha and exhibit asymmetry. Market performance plus 10% minus 10% manager D plus 17% minus 12% manager E plus 9% minus 3%. Both managers' returns reflect more of the market's gain in good times than they do its loss in bad ones. Manager D might be described as an aggressive manager with alpha. She achieves 170% of the market's return when the market rises but suffers only 120% of the loss when it falls. Manager E is a defensive manager with alpha. His returns reflect 90% of the gain in an up market but only 30% of the loss in a down market. These asymmetries can only be attributed to the presence of alpha. Risk-tolerant clients will prefer to invest with D, and risk-averse ones will prefer E. This manager is truly exceptional. Market performance plus 10% minus 10% manager F plus 20% minus 5%. She beat the market in both directions. She's up more than the market when it rises and down less when it falls. She's up so much in a good market that you might be tempted to describe her as aggressive. But since she's down less in a down market, that description won't hold. Either she doesn't have a bias in terms of aggressiveness versus defensiveness, or her alpha is great enough to offset it. Finally, here's one of the greatest managers of all time. Market performance plus 10% minus 10% manager G plus 20% minus 5%. Manager G is up in good and bad markets alike. He clearly doesn't have an aggressiveness-defensiveness bias, since his performance is exceptional in both markets. His alpha is sufficient to enable him to buck the trend and achieve a positive return in a down year. When you find manager G, you should 1. Do extensive due diligence regarding his reported performance. 2. If the numbers hold up, invest a lot of money with him. 3. Hope he won't accept so much money that his edge goes away. And 4. Send me his number. What matters most? Asymmetry. In sum, asymmetry shows up in a manager's ability to do very well when things go his way and not too bad when they don't. A great adage says, never confuse brains in a bull market. Managers with the skill needed to produce asymmetry are special because they're able to fashion good gains from sources other than market advances. When you think about it, the active investment business is, at its heart, completely about asymmetry. If a manager's performance doesn't exceed what can be explained by market returns and his relative risk posture, which stems from his choice of market sector, tactics, and level of aggressiveness, he simply hasn't earned his fees. Without asymmetry, C managers A, B, and C, active management delivers no value and deserves no fees. Indeed, All the choices an active investor makes will be for naught if he doesn't possess superior skill or insight. By definition, average investors and below average investors don't have alpha and can't produce asymmetry. The big question is how to achieve asymmetry. Most of the things people focus on end up not mattering and can't provide it. As I've said before, the average of all investors' thinking produces market prices and, obviously, average performance. Asymmetry can only be demonstrated by the relatively few people with superior skill and insight. The key lies in finding them. Thanks for watching the video. If you liked the content, don't forget to like and subscribe to the Stock Market Advice channel so you don't miss out on future content.